Yield to the ranking Republican member, Senator Marshall.
Well, thank you, Mr. Chairman, and let me also add my thanks to Ranking Member Paul for giving me the honor of setting in this chair, and let me add my thanks along with yours to the committee staff as we close out the Congress for all their hard work. And let me add also my thanks to the witnesses for coming today, taking time out of your day to get here and share your wisdom. It's an honor to serve as ranking member for today's important hearing as we examine how the Small Business Administration can best serve small businesses' capital needs, especially for borrowers in underserved communities. Access to capital is always a top issue facing Kansas small business owners and businesses throughout the country. After hosting several roundtable discussions with minority-owned Kansas businesses, it's clear that our entrepreneurs have solid business ideas and plans to grow, but often lack the resources or connections they need to get business off the ground. I frequently hear concerns about the SBA's lending programs are cumbersome from our community lenders and are filled with bureaucratic red tape for the borrowers, who often give up very early in the process. Due to the high-risk status of any new venture and this lengthy application, many banks have decided to stay on the sidelines. Indeed, entrepreneurs need streamlined access to capital so they can focus more on their business and not paperwork. But some things must be working, as SBA approved a blockbuster number of loans in fiscal years 2021 and 2022. According to SBA's data, in fiscal year 2021, the 7A loan program administered more than 50,000 loans for more than $36 billion, of which 30% of the dollars went to minority-owned small businesses. In total, these 2021 numbers represent an increase of $13 billion from 2019 in approved 7A loans. These numbers are promising for the lending programs, but more can be done, and I'm committed to finding solutions with my colleagues so we can provide more opportunities to entrepreneurs across the nation. This is exactly what will turn our economy around and provide more high-paying jobs for all Americans. However, when changing these programs, we can't forget to maintain strong due diligence standards. While still maintaining simplicity, as these programs are government-backed loans, it's essential that prudent lending standards are in place to ensure taxpayers are not footing the bill on risky loans. The 7A loan program has generally operated at zero subsidy, meaning the program administers fees to offset any loan losses. Recently, the SBA announced two proposed rules that would alter the underwriting and standard practices in the 7A and 504 programs. One rule would also lift a 40-year moratorium on how many non-federally regulated lenders the SBA can oversee. While I hope this allows more access to capital, it's concerning to me that the current administration is changing significant lending policies without input from Congress. It's also concerning that the SBA may not be able to adequately provide oversight and examinations of these new SBA lenders through the SBA's Office of Credit Risk Management under these new rules. Many have seen these rule changes as an opportunity to allow fintech lenders into SBA's traditional lending programs. While it's encouraging to see the SBA is attempting to take steps to diversify its lending pool, it's troubling they are coupling it with loosening of program standards. Fintechs had the opportunity to participate in the Paycheck Protection Program, but recent reports have shown fintechs were responsible for a disproportionate amount of PPP fraud compared to more traditional local lenders like community banks and credit unions. Many of the fintechs in PPP had not been subject to Bank Secrecy Act and Know Your Customer compliance requirements, which led to fraudulent PPP applications being processed. These are major concerns that while automation may streamline certain processes, critical vetting and eligibility checks will be left behind and replaced by high-volume business model with the addition of fintechs and lending programs. SBA loan procedures can often be improved, but it is the key technical assistance to borrowers that differentiates SBA lending, ensures that the borrower is not in a predatory loan that they will have difficulty paying back. In light of findings on fintech fraud and PPP, Congress needs to first examine letting fintechs into new federal lending programs before the SBA implements these very significant changes. Thankfully, we'll have the opportunity to start the conversations today. I'm looking forward to hearing from a witness today who are experts on the fraud and wrongdoing in PPP loans, as well as SBA mission lenders who can speak in detail about how they help underserved communities and the impacts these new policy changes will have on program risk. Again, I believe we can do both. Making the process simpler and streamlined will bring in more lenders, yet we must maintain the integrity of the programs. Thank you. I yield back.
Thank you, Senator Marshall. I certainly agree with your comments. We have to